What's up, you guys? This is a hangout video. I have no idea how long it's going to be or if I'm even going to post it. Going to watch Meet Kevin react to the Fed. Going to look at some crypto in the meantime. Starts in 1 minute or less. I'll go right to it when it starts. Let's see. Talking about the Meet Kevin reacting to the Fed. Like the video, hit the bell, help us out.
I got a video coming about that later, but that's not so important. What's important right now is the minutes, and they come out within about the next 20 seconds. Keep in mind, the only sponsor for this channel are the programs on Building Your Wealth, linked down below. And now you can shadow me as we go look for real estate or house hack. Use that second link down below. All right, S&P is up 0.9%, 2-year Treasury down 1.7 basis points. Here comes the Fed release. Federal Reserve minutes. All right, here we go.
Here we go.
It's actually not out yet.
Here we go. Here we go.
Waiting for it to populate. Okay, I'm starting.
Here we go. We're going.
We get some feed here. Fed officials generally saw inflation risks as a key factor. Many Fed officials highlighted the need to balance.
I'm also watching how Apple,
like
Tesla, and Meta do, and Google too.
Easing of financial conditions. Yeah, that's the big risk, is we don't want the Fed to ease financial conditions too much by bringing bond yields down. But then,
so yeah, I thought you'd get a view of some of the things I do behind the scenes.
And then they have to hike more, right? Bond yields staying up is actually a good thing for stocks. So you kind of want to see bond yields stay up. Okay, getting a little bit more of the statement here. Let's see here. Yeah, get this full statement. There we go. Finally. All right. So, getting a little bit more of the feed. Okay, several officials noted the dot plot tracking notably above the market. Okay, so in other words, they're saying the Fed is above, thinking more aggressively than the market. Cited the risk that inflation could be more persistent. That's old news. Let's go ahead.
All old news so far. Let's see.
That I have it here. I want to look for the word jobs. That's probably the most important part for me right now. Private sector job openings rate as measured by the JOLTS report moved back down in October but remained high. Yeah, well, guess what happened? October was just revised up. That's bad news. And November came in hot. So that's double bad news, right? Okay, so let's make a little note here of that.
So far, Apple starting to swing, not liking it. Tesla
jobs, more staff
kind of indifferent right now. No, it's starting to swing also.
The near term in response to recent estimates
swinging down,
suggesting that the job matching efficiency of companies was not improving as fast as previously anticipated. That's that's a little bit of a neutral statement there, right? Because you're basically saying like, maybe people are quitting because they haven't really found where they want to be after COVID yet. I believe that. Job gains have been robust in recent months. Unemployment rate has remained low.
Some people have been made lazy and are not working. Obviously, if you're in that position and you're not lazy, I'm not talking about you. I'm not generalizing. I'm just saying some, not saying all. So don't get heated.
Inflation has remained elevated. Yes, that's not news. Here we go. Participants observed that the labor market had remained very tight, with the unemployment rate near historically low level, robust payroll gains, and a high level of job vacancies, and elevated nominal wage growth. Now, if you actually look at real wage growth, we really have no real wage growth. Real wage growth is when you have wage growth above inflation.
So everything's being taken down, which I'm not surprised. That's why I'm sitting on the sidelines right now, because I thought that things would come down. I should have made a trade this morning with Apple, but I didn't.
For 3 years, you're basically flat on wage growth when you consider inflation. It's insane. Several participants commented that there were tentative signs of labor market imbalances improving, including declines in job openings. Well, that just got ruined today. So that's bad news, right? Let's see, more qualified, including than anecdotal reports about seeing more qualified applicants. The BLS household survey suggests that job growth in 2022 may have been weaker than indicated by the establishment survey. That's good. It's good that they're seeing that, right? The Philadelphia Fed pointed that out as well, that we're not really creating new jobs. Yeah, there are job openings because people maybe are mismatched, but we're not really creating new jobs. So maybe we're just in an environment where we have higher job openings. Does that
It's a crazy thing when you need to slow things down to speed things up and kill inflation with the economy, but that's the way it goes. Supply and demand, and if there's less demand, less funds floating out, prices can come down instead of too much demand and prices continuing to go up.
necessarily lead to higher employment costs? Not necessarily, but it could. And so we have to track that payroll inflation, right? Something to know is that, of course, on Friday we get the next jobs report. That'll be at 5:30 in the morning.
Yeah, Apple got chopped down
So I'll
real
be
nice.
covering
We
that.
were at 2 plus
Participants
230
commented
or
that
so
labor
when this
demand had remained
started.
strong today despite a slowdown in economic growth, with a few remarking some business
Tesla not so
contacts
much, still
reported
holding
that they would
tight.
be keen to retain workers even in the face of slowing demand because of recent experiences of labor shortages. Yes,
By the way, in case you're wondering what got out of Tesla, as you may know if you watch my videos at 840, I never went back in since, and it was before the split, so the price would be about 330 right now. Yeah, about 330. So I got out at 840 and I'm still sitting waiting.
so you've also got that shell-shocked nature, right, of employers not wanting to let go of good people. Members concur that job gains have been robust, the unemployment rate has remained low, inflation is elevated. Okay, that's old news. Okay, let me see this talk about two-sided, because I'm seeing the feed talk about this two-sided risk. Let's see if the word over-tighten is in here.
It is.
Over-tighten is not. The word
It's January 4th, 2023. It's 2:06 Eastern Standard Time, but most of you will know when the Fed meeting was anyway. Again, I don't know if I'll post this at all, but if I do, you'll know at least when I was recording it.
word over is, but that brings up too many things. How about recession? Do we have recession in here? We have two words, two times the word recession is mentioned. Sluggish growth in real private domestic spending expected over the next year. Okay, so this is interesting, right? Sluggish growth in domestic spend over the next year is an expectation. Subdued global economic outlook, persistently tight financial conditions were seen as tilting the risks to the downside around the baseline projection. This is a way of basically warning the Fed, like, hey, let's not go too overly tight here, right? The staff viewed the possibility of a recession sometime over the next year as a plausible
I think we've already gone too overly tight, but that's another matter.
commentary. Jerome Powell basically gave us a 50-50 from JPOW on recession versus non. And that's really new. That's a big time, a big moment of them, or a big admission that they realize, yeah, like we might be forcing recession here. Few participants remarked that the current configuration of nominal yields with longer-term yields lower than shorter-term yields have historically preceded recessions. That's the inverted yield curve. However, a couple of them also noted that the current inversion of the yield curve could reflect in part that investors expect the nominal policy rate to decline because of a fall in inflation over time. Participants generally noted that uncertainty associated with their economic outlooks was high, and the risks to inflation remained tilted to the upside. Possibility that price pressures could prove to be more persistent than previously anticipated. Not great. Due to the labor market staying tighter than anticipated. The JOLTS numbers today were just bad news, right? I mean, and unfortunately, a lot of these minutes so far are talking about again, jobs. That's not great. We don't only want to talk about jobs here. Yeah, let's see. Start, sure, okay. Let's see. Okay, let's go to the next search result here on recession. Oh, we're at the final search result. They noted for recession. They noted the sources of risk include unexpected negative shocks, possibility that household and business concerns about the outlook restraining their spending sufficiently to okay, that's not a big deal. What about anything on rate cuts? That would be really interesting. So let me just search for the word rate.
That would be very interesting. Let's see.
Rate appeared to contribute to improved sentiment. So central bank communications signaling a slowing pace of the policy rate contributed to improved sentiment. That's fair. Regarding the outlook, both the market and desk survey measured expectations. In the December survey, the median respondents model expectation for the path of the Fed funds rate in 2023 shifted higher by 25 basis points relative to November. Let me see what the Fed terminal rate is today.
Is not.
Terminal rate.
Not at all going to be good for the reaction of this right now.
We were sitting closer to about 4.9. Let me see the phrase runoff. I'm seeing some of this come through the feed here. Only one mention of balance sheet runoff, suggesting that their quantitative tightening is basically proceeding smoothly. Okay. Now, one of the things to remember with balance sheet runoff is that you actually increase yields because you have less buyers for bonds in the bond market.
That is true.
When they're running off instead. And so you keep yields up, you keep financial conditions tighter that way. Looking at the 5-year break even for an inflation outlook, let's see here, because bonds right now, the 10-year sitting at 3.72, definitely elevated, definitely going to hurt real estate. And the 5-year break even, how's that reacting after this?
Yeah, like I said, Dow cuts gains after Fed meeting minutes signaled more rate hikes
It's at the
ahead.
third lowest point all year right now on inflation break evens. It's probably
I'm not surprised. I'm sure you're not surprised. Let's see what Kevin continues saying here.
Sources of inflation come down before they really start lowering rates. Regarding the outlook for inflation in the U.S., the inflation compensation implied, this is the break-evens talk right here. This is break-evens. Responding to lower than expected CPI.
Apple broke 52 weeks low yesterday, so that's why I didn't get in at the end of day market yesterday. Looking for a quick few bucks today, even though it did do that had I gotten in, but I didn't feel safe to do it for that trade.
Staff review of the economic situation. I'm also watching the feed here. Not much coming through that. Yeah, so no discussion.
Comment down below. Let me know if you're watching here, if you like this style of video, and hit the like button.
Oh, let me look at the spiral part, because they added the spiral part a few minutes. So they added it while they were facing the dynamics. They added this section here. That's very important. Where is it? Wage here it is. Consequently, while there were few signs of adverse wage price dynamics at present.
All right, so you get the idea. More hikes ahead. Not good. See you next time. Thanks for watching.